right, so we grabbed some of the smartest minds in the newsroom to recap, talk about, and talk forward the 1987 crash. We're here with Michael Brown, our assignments editor, who basically launched this whole project, which we'll get to in a second. Ron Fink, executive editor of The Deal, and my friend James Langford here, bank and financing editor, who knows all things crash. Michael, first tell us about, though, what we're doing, what we did on the street, what people should look out for.
Sure. Excuse me, at the street, we've done about 5 pieces so far. We're going to have about 20 pieces in total, kind of covering all aspects of the crash, from the cause to the actual day, kind of what happened then, and then looking forward, what could cause the next crash, what has caused subsequent crashes. You know, really trying to sort of inform our readers about what to look out for, some of the signs that folks in '87 looked out for or didn't, and you know, try to get in front of the next one.
I mean, it's a lesson in history now, right, Ron? I mean, 30 years. Biggest drop still for the Dow in history.
Right.
So where were you in 1987?
Well,
the day of the crash, I should say.
The day of the crash, I was working for a bi-weekly business magazine for doctors, writing personal finance column for that. So when you're a bi-weekly, you kind of treat a lot of the news as noise, basically.
Yeah.
But this was kind of hard to ignore. It was a little loud. And so by the time it ended the day, I was like running around the reservoir doing my jog, and I heard these 2 guys behind me just screaming and shouting about how bad it was. They were obviously traders, and I thought, this really was bad.
I should pay attention.
Yeah, yeah. But you know, when you write a biweekly column, you're trying to, you can't write about current events. You have to look forward. So 2 years later, the market had recovered the loss, which seems like a long time, except when you compare it to the '29 crash, which took 25 years to make up.
Right,
so.
right, for sure. Michael, we love you, but we know you weren't here yet.
Right.
I have already stated that in 1987, I had just gotten my driver's license and was shopping for a prom dress. So the market really meant nothing to me.
It meant something to me. It meant something to me
I'm
because
sure it did.
I had just gotten my driver's license not long before, and I decided that it was time for Dad to buy me a new car.
Uh-oh.
Uh-oh.
And that day, he was completely uninterested in buying a new car. He was more interested in reliving his horror stories of the Great Depression, which
Right.
we had grown up hearing, and he was convinced, looking at that 22% slide, that it was like the Black Monday from 1929 all over again, and the Great Depression was the next thing after.
That's what it felt like to people
Yeah.
at the time. Yeah.
But so what happened? What? I mean, you know, lack of liquidity. Like, is it the basic textbook stuff?
There
Well-
was a lack of liquidity.
For
That
sure.
was part of it.
Right. And ironically, it was trading that was designed to kind of hedge against this sort of thing. Everyone was doing the same thing, though, and it all kind of went south as a result. This is, I think, the first, to my mind, use of like technology to like program trade. I mean, it was called program trading,
Right.
and it was designed to hedge against declines like that through something called portfolio insurance. Well, it seemed to create what it was designed to prevent.
It's funny because we still to this day have this conversation about man versus machine, right? Do we need people? Do you know? Can the exchange go all out technological?
I mean, I think in some ways a lot of the trading has become sort of all electronic. I mean, you look at the news events of the day, they don't really seem to move the markets as much as they once did. The black boxes don't really listen to the natural disasters and the terrorist attacks that happen. They just, find the bottom and buy at the bottom, sell at the top.
It's all so one of the things we did get out of '87 though were these circuit breakers. So this notion of let's try to prevent this. I feel like we're constantly behind the 8 ball with this stuff, right? But that being said, these circuit breakers.
Right. That was one of the major products that people remember coming out of the '87
And
crash.
what is the point of that?
The idea, basically, you can stop trading for long enough for cooler heads to prevail, in theory.
So you just literally flick a switch.
In metaphorical terms,
Yes.
yes. You just like stop trading in a certain stock.
Yeah.
Like originally it was, basically done on the floor of the stock exchange. The
Right.
specialists would say we're stopping it now. But now it's like a lot of it's done through a computer, but basically it works on the same principle.
And Ron, we started talking about how flash crash now in 2010, same thing, here we go again. I mean, what have we learned? Have we learned anything?
Well, I think, if I'm not mistaken, circuit breakers kicked in to
Yep.
prevent that from being worse. And I think that the recovery there was very soon, very quick from the flash crash, if I'm not mistaken. I don't remember.
There
James,
was-
do you remember
well,
how
there-
long it took?
That all happened within minutes.
Right.
And
Right.
part of the reason, there were circuit breakers that were, halted trading for certain periods to like let the market bounce back. But there was liquidity available to absorb a lot of what was being sold in the flash crash. What had happened was that, there was a mutual fund group that unloaded some index futures, like $4 billion worth, more or less, in a matter of minutes. They did it through an algorithm. It was done very, very quickly. And there was not like enough momentum to buy it that quickly. So you saw everything drop, and then it sort of bounced back once the market digested what was being sold. In a way, it was like the '87 crash all over again, but much faster.
Yeah.
Right.
Yeah.
And that was what had happened, like you said, with the program trading, the portfolio insurance. What had happened was there were some fairly new securities called index futures that were being sold in Chicago. And that's how portfolio insurance worked. If you had a large holding in stock in New York, started declining, the strategy was to like short sell your index futures and make up for some of the loss.
Are you talking about 87 now?
Yeah, 87.
Right.
That was like the early, one of the earliest forms of program trading. And there were computer models that advised, decided when that should be done and like basically executed the orders.
It's an important part of our history, though. People should know about this. Although, should they not? I mean, maybe at this point we're past it. Who cares?
Well, to Michael's point, with so much of it automated now, it's kind of hard for individual investors to like know what to do in the middle of all that. I mean, it's hard for them to know what to do, on any news because it's all baked in the market so quickly. I mean, the trick is to look ahead if you can, and take a longer view. And I mean, it's easier said than done, I suppose, in the middle of it all.
Well, I also think that it has to do with the rapidity at which you trade. I mean, if you want to be in the market for the long haul, you don't want to be in the market for a quick trade. I think that's part of the package that we put out today. Actually, it talks about kind of staying pat and riding these things out. I mean, in the long term, the markets tend to go up. If you panic, which is what happened in '87, there was a lot of panic. You're bound to make a mistake. You're bound to not see a bottom or nor see the top. So, that would be, I think, something that we've learned is to sort of not freak out in these scenarios.
Or have we like really learned that? Still to this day, I feel like people, they sell high. They sell when it falls, and they buy when things are at the top again. So I mean, it's almost like human nature, just to
Well,
like.
it's the instinct. I mean,
Right.
you see like your holdings sliding, you're like, oh, I want to get out before it goes any lower.
Right.
By the time you realize that, it's already too late. Unless the company's like certifiably going under,
Right.
you're probably better off staying with it and hoping for a bounce back.
Right.
I mean, the Benjamin Graham style value investing, I mean, it's what Warren Buffett does, is kind of hard to practice when the market is basically all about momentum. Those are the two schools, basically,
Sure.
value versus momentum. And I always thought the value guys made more sense because you could at least, kind of like put some numbers to like,
Yeah.
so you could actually
The
value
P
something.
multiple would be
Yeah, you apply
rash
PE multiples
would be nice.
or whatever. But I remember writing an article about IBM being, expensive back in the day, and the Wall Street Journal having an A1 leader saying that it didn't matter what its price was, people had to buy it because it was, it needed to be in all the big portfolios. And
Because it was Big Blue, you had to have it.
Right. I'm not sure at what point in IBM's history that exactly that occurred, but at some point there's a saying for every strategy, and that one's called "Don't fight the tape," basically.
Right.
So.
You also hear a lot of froth around people saying that you have to, how you can invest like a billionaire. Well, part of the way you invest like a billionaire is having scale. Most ordinary people can't do that.
Right, you
So
start
they're
with $1
going to
million.
Yeah, they're going to freak out when the stock starts declining because it
can't afford
represents a
it,
big part of their retirement.
Right.
If you got $1 billion to live off of, you can afford to lose $1 million here and there, and it won't matter as much.
Right.
What's the answer then? I mean, Michael, arguably we're saying don't read us.
I don't think that's the
Don't
case.
pay attention to us.
I don't think that's the case, but I think you have to make informed decisions, as our friend Jim Cramer always says. You have to sort of know the stocks that you're investing in inside and out. So I think that's one of the reasons you come to TheStreet.com. You come to learn about
Good
these
one.
stocks inside and out, where
And
you're
you
going to
diversify.
absolutely
Right.
you diversify. And read today, and again, one of the pieces that we've done is, if you're not willing to hold a stock if it loses half of its value, you should maybe think about, do you want to own that stock? I mean, is it something that you believe in long term? And is it a smart play? Is there growth there or not? And if it's, an inflated valuation and you are holding it to hold it, I would maybe look at, want to take a look at your portfolio.
Is that a lesson then that people should learn from all of this? Is that if you don't have the time to do what Michael's saying, either don't do it or hire someone to do it for you?
I think that's
right?
absolutely. I think that's absolutely
the
the
safest
case.
way to
I mean,
go
that's the idea behind indexing. It seems to me,
Right.
basically.
Yep.
And there are people like John Bogle who say that's the way to go, basically, for that reason, I think. I mean, it's just a more extreme version of diversification, basically.
Yeah, that's basically what happens with mutual funds, with 401ks, with indexing. Like you said, it's letting someone else manage it for you. I mean, the trade-off there is, you might miss something.
For sure.
Yeah.
So,
But theoretically, you'll be safer.
I mean, it depends, I think, ultimately on your time horizon, basically. Can you afford to
Sure.
wait?
Sure.
Where are you in terms of retirement or, your other goals? But that's what 401k investment advice is all
Right.
about, basically. And that's why you see things like like life cycle funds or lifestyle funds.
Right,
you know,
turn down your
Yep.
risk. Yeah.
Yep. Do we worry? I mean, should we ever worry about something like that happening again?
Yeah.
Really?
Oh, definitely. Like,
Really?
what happens when these things happen? It's like regulators come in and they try to set up a system to prevent that from happening again. So you're always like creating a security mechanism for what happened last time.
Yeah, so we're always behind
What
the eight
happened
ball.
last time is seldom the same as what's going to happen the next time. The thing with the 87 crash, and I talked with the author of a book on that last week, is like this was the first time you really saw programmatic trading come into play. It was the first time you really saw these complex, for the time, derivatives being traded. You had the index
Futures,
funds,
yeah.
index futures. These things all happened again in 2008. And the other thing that happened again was in the 7-year bull market leading up to 87, you had Reagan in office talking about cutting regulation, freeing the free enterprise system to do what it did best. You came to this situation and there were less regulations, less budget on law enforcement than there had been, and you had a big crash. The same thing happened again in 2001, 2007 under the Bush administration. And not for nothing, you have lots of conversation now about let's cut regulations again. Let's make the free enterprise system, do what it does best and grow the economy.
How does the Fed come into all of this? I mean, unwinding a balance sheet. Are we sure that it's the best thing to not stopgap?
It kind of depends on your viewpoint.
Yeah. I mean,
The
I'm
creation
curious
of-
to hear from you.
The creation of the balance sheet, or explosion of the balance sheet, getting it up to 4.5 trillion, was all done to keep the market from crashing, to put liquidity back in. There's a lot of concern that unwinding that takes liquidity out of the market.
Right.
You're not going to have as much as you did. On the other hand, Fed is very well aware of that, and they are doing this super slowly. You're seeing 4.5 trillion. Expectation is now they'll unwind as much as 50 billion a month over the next 2 years. That won't get anywhere close to getting rid of the 4.5 trillion.
Sure.
It'll take maybe 1.5 off.
And you won't feel that.
Hopefully.
I was going to say that, James, and I think all of us are actually making a distinction here without kind of bringing it to the forefront between a flash crash and a financial crisis. The 2008 crisis, I would argue, is far more significant than the flash crash.
Fair enough.
Agreed.
And when you go back to 29, of course, you were talking about a depression. Now, that's what the market or what observers were concerned was going to happen in the wake of the 87 crash.
Right.
It didn't.
it didn't.
But if it weren't for the Fed, I think one could argue, and other regulators, some people would say they made a mistake with Lehman Brothers and letting it fail, but they were kind of in performing triage there, basically, with financial institutions that were failing. So that was more than just a dive by the Dow. That was a true financial crisis that could have turned into a depression, I think. So, whether we should be concerned about that happening again, I don't think there's anybody who would say no to that.
And wasn't that the it seemed to me that in doing the research that 87 people were, there was some events leading up to that crash that people were already nervous about the economy and the state of the financial
other markets
systems.
had fallen, right?
Right, and
Hong
the bond
Kong,
market, and the
Australia,
bond market
Spain.
as well.
There have been a lot of talk about froth in the markets and indexes declining. The difference was between 87 and 2008. There was nothing severely wrong with the underlying economy at that point. Like the markets were considered to be inflated. And the reason they fell that much and you didn't really see a recession after, or at least part of the reason, was that the underlying economy was not in bad shape.
Right, whereas you had a housing
In
bubble.
2008,
What about the default on their
completely
mortgages or their car
disconnected.
loans or
Not
whatever?
disconnected. It was connected to like what was happening with other asset prices,
Yeah.
but it was part of the real economy that just evaporated.
Yeah, and the U.S. economy is largely consumer driven. When you saw housing prices drop that much, that's where the U.S. consumers get their wealth
Right.
from.
Sure.
Right.
And the housing
Sure.
prices were dropping. So people were scared to spend, and you saw the results of that.
Yeah, because that really hit home. So then do you worry that something like that's going to happen again?
Those things are so hard to predict. Although
Yeah.
there were people, lots of people talking, like Bill Gross, for example, writing about inflated housing prices and the trouble with mortgage-backed securities and leverage levels as a result. I mean, if you look at
There
those
was
things,
that movie. What was the movie about it all?
Well,
The Big
there were-
Short.
The Big Short.
Yeah.
Big Short.
I mean, there were a couple things a couple movies that came out of that were, on point basically. I think you have to be concerned about that, and that's why, bank regulators will look at leverage levels, and to James' point, there's a debate about whether to let the banks, take more risk or not, and that's where the Fed plays a big role, and we'll see, whether Randy Quarles is as much of a stickler as Dan Tarullo was. I think, there might be some concern that he's not, and you'll see a comeback for some dicey securities in banks'
And
portfolios.
the other thing, like Arianna Huffington, in a somewhat memorable speech after the crisis, said the problem in America had become that we stopped making things and started making things
Well,
up.
finance becomes a bigger
And
part of the economy.
That,
Yeah.
it matters because when you see something like the housing bubble, there were actual assets there. Like if you hung on to your house and your piece of land, eventually it would probably be worth something again.
Sure.
If you pick something like credit default swap, for instance, maybe
Right,
not.
a made-up
Or
security from
Bitcoin, as
bank.
Jamie Dimon
Right.
would
Well,
say.
right. That's the,
Right.
And he traced it to the tulip bubble in the 17th century. You don't see anyone paying the price of a house for tulips now.
Right.
But it's greed is good kind of thing, right? I mean, like the subprime market was created to help soldiers and to help people like teachers who didn't have solid incomes. I mean, I got a subprime loan when I first got separated because I couldn't qualify for another mortgage. Like it was a product created to help people that just went bad really, really
Well,
fast.
the problem was not like
Wasn't
giving
the
loans
product?
to people.
It was. Go ahead.
Giving loans to people with poor credit. It was giving loans to people with poor credit and then misrepresenting them
To
more
investors.
or less to investors.
Right.
Yeah.
Right.
The people who bought these mortgage-backed securities didn't think of it as, I'm buying a home owned by, an ex-con who's making $200 a week and has bought a $100,000 house. They thought they were all getting like homes owned by
people like me who were working really hard to make
Right.
it.
Exactly.
Yeah.
No.
Yeah.
No.
Yeah.
So there very well could be another product like that bubbling as we speak.
Well, I think that's just it, that you don't know what other financial products are going to be released. And I mean, from Bitcoin to Ripple, from whatever, I mean, the more that we put stock into these alternative financial markets or financial instruments, I mean, that only adds to sort of Ron's favorite word, uncertainty, in the world. And that's what, that's the one thing investors really don't like. And that's the one thing that I would say the black boxes don't like when they're, looking to, they're looking for certainty.
It really is a matter of knowing the underlying worth, like
Right.
you said earlier, looking at the products individually. And you saw that in The Big Short. There's a scene where a guy who's investing in one of the mortgage-backed securities goes through and looks at each of the mortgages in that portfolio, and he figures out some large percentage of them are underwater and not being paid.
Okay, so where do we go from here then? I mean, like, it's one thing to tell investors to have a long-term view and to be diversified and
Well,
it goes in one ear, out the other.
You know, I mean, if you actually do look at PEs, they're not that high. You know, I mean, so the market, and that's why I wasn't surprised when Buffett said that stocks were actually, you know, fairly valued a couple weeks ago. I mean, I haven't, you know, you have to adjust that for cyclicality, which is what Robert Shiller does, and maybe look at estimates, you know, rather than, you know, trailing 12 months.
What does that mean for this person sitting at home with their 401k? They have to go look at a PE. What does that mean?
It means knowing what. Ultimately, it means knowing what you're investing in.
Yeah.
Like
Not just the product.
The Camaro you bought. Like your parents probably wouldn't have bought it without looking under the hood first. It's the same thing with a stock or a bond or any kind of security. If you don't know what you're investing in, you probably shouldn't put your money into it.
And I mean, the PE is simply, you know, the price of the stock versus what the company's earnings, and you compare that with what its average was, or if you're looking at the market more broadly, you know, what the market's average was historically. And you know, it's not a foolproof science, but it gives you a sense of whether things are expensive or not.
Sure. Well, we look at these IPOs every day, and I say, how is this company going public? They don't make any money, or you know,
Well,
there's nothing to be investing in here.
I mean, if you go back then to the
tech bubble.
Yeah, the tech bubble,
right,
and the meltdown there, you saw a lot of that. And that's probably what feels most analogous to me when I look at some of the tech companies that are coming to market without any earnings, or I look at the number of quote unicorns that yeah, I mean, there was a piece today on some research about how of 134 unicorns, if there can be such unicorns, if there's 134 of them, half of them.
But wait, what are we calling a unicorn these days?
Companies with private companies that are worth more than $1 billion, basically.
Right.
So there's like 135 of them, according to this one study. And the study concluded that contrary to like that headline value, they're probably worth about half that much because of some of the games that they're playing with valuations.
Well, because they're private too, right?
Well, they're
they
private,
don't have to,
but
like,
there's a secondary market there where they're being traded, and there are different
hype
kinds
of the VC as well,
and there's different kinds
you
of rights that are attached to different classes of shares, and that's where there's some gamesmanship involved, and why these guys conclude that they're worth half
But
that.
that's interesting. That's
So,
a little deja vu. All
I mean,
over again.
that feels. I mean, if you're talking about something that feels frothy to me, it's tech in comparison with the 2001. I'm sorry, the
2008.
The
And
98.
here's
98.
98. Sorry,
98
deja
bubble.
vu for
Yeah.
me
The
is I was
dot-com
in this
bubble.
Yeah,
newsroom,
dot-com bubble.
this exact newsroom when that dot-com bubble exploded. And to say that you're feeling that all over again, that's kind.
That was more fundamental than sort of like some kind of program trading kind
Right,
of
because
event.
Globe.com had no numbers.
It wasn't about technology.
Red Hat was red.
It was about technology in terms of like the assets, but not the you know the form of the meltdown. Basically, it was a fundamental thing.
So are you feeling that now too?
I feel more of that than I worry about some flash crash or some Black Monday.
Like so. You know, for the kids who didn't witness it, you can almost say, put it back in the history books. It's not going to affect any of us going forward.
Well, that you know the tech bubbles bursting. Actually, I remember. I think it was Dan Gross wrote a book that basically said, you know, these bubbles and these bursting things are it's sort of part of creative destruction. Capitalism's way of kind of, you know, clearing out excess and getting back to like. But to a normal kind of economy, but that you need it to kind of supply capital to these growing startups and the like.
They used to say the market would puke itself,
Well,
right?
yeah, it's self-correcting is what
Yeah.
they would say, and you could say that about the tech meltdown, I would argue, because the economy kind of came back pretty quickly, although it didn't come back very strongly, and maybe for other reasons that had nothing to do with the markets per se. But then came 2008, and it's like, wow. You know,
Yeah, the thing is, the market may puke, you know, up what's not working, but you don't want your cash to be part of
What's puked all over the floor.
Exactly. And you know, like 87 was 30 years ago, obviously, but there are like some of those basic themes. You can still see those if you look, and you don't even have to look very hard. You can see those underlying factors playing around today, and when you see them, that's probably a sign that you want to pay more attention. Like, so not so much relegate it to the history books. It's like, look at the big trends and, you know, say, how can these like inform what I watch for the next time?
Sure.
Are you talking about when you see some elements that are that are similar? Are you talking about the high frequency trading or
the algorithmic trading
yeah.
to some degree,
Yeah.
the complex financial instruments, the
Right.
like loosening regulation. I'm not going to say there like actually will be a problem, but those are things you want to pay more attention to when you see that build up and you see people say things like, "Oh, there's not a problem. This time is different." Like that was a key word in 2006, 2007. Housing prices are never going to stop going up.
Yeah.
But they did.
Of course they did. But and we don't have a lot of time left, but you know, when they say history repeats itself, does it truly repeat itself?
No, it
Because
rhymes.
It just rhymes. There you go. Because
I
it's
think that's
different.
Twain. Yeah.
It's different. Things are different. We didn't have ETFs in '87. We didn't have high frequency trading in 2001. Like things are different.
It's different,
Things are
but
different,
the
but
principles
they're
are still
yeah,
there.
exactly.
You know,
they're variations on
types
the theme.
of technology.
Yeah.
Yeah, the
I mean,
variation
high
of the
frequency
theme, I think.
trading was there in 2001. We didn't call it that necessarily.
That's fair.
But there was not like, there was a line from like the program trading of the late 80s to the algorithmic trading today. It didn't like stop. So, you know, that was still happening.
No, you're right.
too.
Someone didn't snap their fingers and it showed up.
Right.
Okay, so going forward, if you could create a perfect, more equal market, what would you want to see?
A more when you say more
Well, just
equal
fair
market,
for people. Like it's not to me. Sometimes it doesn't feel fair to the little guy anymore, right? If it is all program trading, if it is all
it goes in cycles, I think. And I mean, I guess you know, despite the contention that you need booms and busts to kind of create a dynamic kind of economy, I would argue that something's that's a little bit more of a gentler wave is probably healthier long term. But it's been 10 years since the last crash, and I don't know what that says. I mean, maybe certain sectors are more richly valued than others. I wouldn't be surprised if tech isn't, for the reasons we were talking about. But you know, that's an argument to look at more older industries, perhaps. You know, I mean, Buffett's kind of a good example of that.
I mean, one of the things you do to make a market more equitable is share information. How the markets wind up being inequitable is because some people have information and they're using it and the others don't.
And you see that
and they tend to be the losing side of the trade.
Yeah. I mean, when we saw Enron happen, and in the wake of that, and Sarbanes-Oxley, which was designed exactly to do what James is saying, is basically put more information out there and make it more trustworthy. There's been a backlash against that because it inhibited capital raising by startups,
and it
that's,
cost companies
that's
money.
Kind of where that's kind of where the cycle has gone again. So I mean, the Jobs Act in creating a lot of these private companies and probably some of these unicorns through the secondary market could be setting us up for some of that too, particularly if these companies are really valued at half what they're being bandied about at.
And that's part of what the financial press does when it's working at its best. To your point about reading TheStreet.com, that's really like ultimately
because you said the
what we're
information's
here
not being
for.
shared. There's more information on our site in like an hour than there is in some places in a week.
There's also it's about quality of information too, not just
volume.
volume.
Yeah.
So yeah.
No, but we got that too.
Yeah.
We happen to check both boxes there.
I think we could probably do more valuation analysis myself.
I don't think you ever
into everybody's. That's because I don't think you ever can do enough of that. So.
Yeah, absolutely.
I mean, ultimately, the markets, have always been a caveat into a situation. It's like buyer beware.
Yeah.
Kind of like the Lehman Brothers CEO said. You're looking around the poker table and you don't see the schmuck sitting there, then the schmuck is you.
Right.
All right, on that note, that's actually a great way to end this. And God willing, no one's cash goes puking through the NYC floor anytime soon. You guys are awesome. Thank you. Everyone should read their stuff.